So we can call it to order, and as you guys are aware, Cambridge is here to go over the annual report with us.
Right. Yeah, so I don't know if you have anything else on your agenda, but if not, Brian and I will take it away, I guess.
We'll let you guys go first, that way afterwards you can head out rather than sticking around and going over the releases that we have.
Okay.
Okay.
Anything on your agenda?
Yeah, so just very quickly, of course, you all have probably heard about Cambridge Trust's merger with Eastern Bank. So that's made, a little bit of news lately, but we're calling it a merger. Eastern actually bought Cambridge, but we're calling it a merger because the retail banking side of Eastern sort of took over Cambridge, so any Cambridge Trust branches became Eastern Bank branches. But on the wealth management side, so Brian's and my side.
Brandon, what? Brian? This is the second time you call me Brian. We've known each other for like 6 years.
We have a Brian and a Brian.
Too close, too close.
Too easy.
Brandon and I.
I expect so much more of you, Lisa.
I know, it's terrible.
Good old, yeah.
Yeah, right, exactly. Good old whatever his name is.
Yeah.
But anyways, we are on the wealth side. Cambridge Trust is effectively taking over Eastern. So Eastern's wealth management group is merging into Cambridge Trust. So we're going to be keeping the name, our emails, our phone numbers, our team, our systems. Your online access will not change. You'll still be hearing from me on a monthly basis, and Brandon, and I on a, as often as needed and wanted basis. So yeah. So I think that probably Justin, you and Sarah might be getting letters from us in early August.
Okay.
Just sort of reviewing all that and then also sharing the new Eastern Bank privacy policy. So
Perfect.
you can look out for that. But
Because Londonderry doesn't bank with us, right?
No.
Okay.
yeah.
Okay.
Correct.
Yeah, so the impact will be negligible.
Really
I would
minimal.
think,
Yeah. Really, it
Much-
should be transparent.
Much bigger thing on the banking side, and the merger was formally completed. What was it, last week or 2 weeks ago?
Yeah, I think 2 weeks ago.
Yeah.
So Friday the 12th.
Yeah. So,
Yep.
but yeah.
So yeah, but again, it should be absolutely transparent. If you have any questions, concerns, anything, do not hesitate to reach out to either of us. So yeah. But I think, and then of course, annuals. So those are all set. I've forwarded the information to you.
Yep.
The cemetery reporting this year, hallelujah, is much easier in that we are simply, we used to have to include every single lot record in the actual MS9. Now we're simply attaching the lot record to the top level cemetery fund. So much, much easier, and which is good because Londonderry has a very busy cemetery. So.
Can you describe that, just that attachment again? I missed the term.
Sure, it's just an Excel spreadsheet that we are now attaching to the top level cemetery lot, cemetery fund record. So we have the top level cemetery fund, and then that is then broken down into all the individual lots.
Thank you.
Yeah. So we're very pleased about that.
Wonderful.
Yeah.
One question.
Mm-hmm.
If something happens to Eastern Bank, are the assets that are in protected from
Yes.
that? So there's a wall between the both organizations?
Yes,
Okay.
absolutely. It's actually not between both organizations. It's the fact that, so Cambridge Trust, our custody, our asset custody services are provided by a separate organization entirely. So we use a group called the SEI Private Trust Company. And so the assets are in that nominee name, although they are, effectively assigned to the town of Londonderry. So they are
Okay.
your assets alone, not part of the bank. So anything that happened to the bank would not affect your assets.
Okay.
Yeah. Yep. So, yeah. All right, and then, just as a final note, again, on the annual, I added Brian's name to the, reporting so that you are listed as a trustee, so we've got the current record of trustees,
Thank you.
on the MS line, so,
So that's all set for me to now enter the capital reserves and all that fun.
correct, yep,
Wonderful.
yep. So, all ready to go. All right, so that was all I had,
Okay.
yeah.
And so, yeah, so I have a deck here as usual, we can review. Is there anything specific you guys would like to talk about today, or just kind of review the portfolio and make sure things are going the way you expect them to go? Anything in particular? Just,
Not for me, I'm not sure about the trustees.
okay.
I know Brian.
It's a general look at the
Yeah.
portfolio unless, you know, and then particular questions as they come up. So,
Okay. So yeah, so in this deck, there's a whole lot of slides up at the front, mostly kind of reference slides, comes up in conversation, but let's, for the time being, skip to page 20. This is where we begin getting into some of the reports about the specific account. And yeah, things are going well, right? Things have been really strong across both the markets and the economy. You know, the broad U.S. equity market is up something around 15% so far this year, so it's pretty solid, and I think it's pretty unexpected to see that type of strength in the stock market this late in the economic cycle. This portfolio is a roughly balanced portfolio, right? It has both stocks and bonds as well as some cash and alternative assets. So equities have decidedly been strong for several years now, including this year. Bonds have been generally weak over the past several years. You know, interest rates moving up dramatically. That pushes down bond prices. Year to date, bonds are mostly flat. So really, it's the stocks that have been driving the train here. We obviously keep some level of cash, which in the past has been painful to own, because you know, not too long ago cash was earning 0%, and now it's earning over 5%. And so, you know, we have an income portfolio here, and maybe you can speak a little bit about the income portfolio and you know, it's not really being drawn from, right? So there's really not a meaningful distributions of any kind coming out of this portfolio since I've been managing it anyway. And so as stocks pay dividends and bonds pay coupon payments, that income goes into a separate sub-portfolio. And that sub-portfolio is intended for distributions. It's not intended to be reinvested, and especially not in risk assets. And so the cash balance in this account has been sort of climbing as income continues to be generated by the portfolio. That gets carved off. And since the money isn't being spent, the cash kind of just builds. Still a relatively small part of the portfolio. It's about 10% of the entire account. And it's actually less than that. It's actually about closer to 8% of the entire account. If we carve that off, we're looking at page 20 in the top left, shows the asset allocation. If we carve off the income portfolio, which is included in these figures, and just look at the investable portfolio, let's call it, the one that's intended to grow, the portfolio is mixed just the way it should be. So 60% stocks, about 37% bonds, and then about 3% cash. Portfolio from an asset allocation standpoint looks perfect. Nothing I would or could change there. And you know, in the bottom left here, just a simple line chart shows what the portfolio's done since 2015, which is when we started working with the town of Londonderry. And that blue line is the portfolio value. So it's going upward and to the right, just the way we would hope to see. Obviously some choppiness here and there, especially around the COVID era, but things are going well. I mean, we're seeing solid growth, and because there aren't significant distributions being taken out, allows it to grow even farther. The green line on that bottom left indicates the capital invested. So you can kind of think of the green line as what the account would be worth if it weren't earning investment returns. It's mostly flat, right? You're not taking distributions, you're not really making contributions to the account either, and therefore the green line is relatively flat. You see that little bump in 2021. Presumably there was a contribution that I can't remember.
Yeah, The Jake Norr
I was
Scholarship.
gonna say the Jake
Okay.
Knapp probably.
Yeah, so that's where that went in. And, you know, things like that, the timing was good. Markets were not quite beaten down the way they were in the spring of 2020, but still low in hindsight. So we got to invest that money and earn significant returns on that money since. The bottom right here on page 20, dollars and cents, you know, like what has the portfolio done? How has it grown? What has driven the growth? And so we see the beginning portfolio value, meaning a year ago today, the account was worth about 1.75 million. About $18,000 or $19,000 of distributions, and that would largely be our management fees would be included in that. I'm not sure if there were any distributions like.
Yeah,
There's,
again,
it's
scholarship
small.
fund.
It's 17, last year was 17,500 for the cemetery
Cemetery, yeah.
maintenance, and then 8,888 for the NAR.
Yeah.
Got it. Okay. Okay.
And then cemetery deposits offset that a
Yep.
little bit.
Yep.
So.
The income earned, so that, again, that's the coupons and the dividend payments, that $60,000 there flows to a sub-portfolio that's included in this account. So $60,000 of income and then $135,000 of market appreciation over the course of the 12 months. So solid. It's tough to be upset with it. Comes out to an 11+% return, investment return over the past year. Better than expectations. We're certainly happy with it. You know, to some extent, the market has gotten a little bit euphoric, which is always a cause for concern, right? Once you start getting calls from clients wanting to up their risk and add to equities and sell the safe stuff, it's kind of a contrarian indicator that maybe there's a little bit too much ebullience in the market. You know, I would say that excessive optimism is probably the leading cause of bear markets, just because it leads to the stratospheric asset prices that people finally at one point say, hey, you know what, this is kind of crazy, I'm going to take some profits, and then it begins to snowball. We don't really expect a bear market over the shorter, even intermediate term. Ultimately, markets are up for all the right reasons, or for most of the right reasons, and the biggest reason is just strong corporate earnings growth, right? Corporate America is crushing it right now, making money hand over fist, and that obviously drives valuations higher. That's a good reason for markets to be moving upward. A bad reason is just simple speculative fever. You know, you look at like the 2000, right around 1999, 2000, speculative fever. We all know how that turned out. So we don't really have huge concerns about a bear market. A pullback is certainly expected at some point. We would expect a pullback to be relatively fast and manageable. And it would probably be precipitated by one of two things. Either the economy begins to slow dramatically, which would be indicated by the labor market, or inflation begins to ramp back up, which is still within the realm of possibility. And if inflation begins to ratchet back up, that sort of puts us in a bind, puts the Federal Reserve in a bind. It would cause the Federal Reserve to have to put the brakes on the economy, which usually translates into lower asset prices. But neither of those things seems particularly likely at this point, so we're comfortable with the level of risk in the portfolio. I certainly wouldn't be going overweight risk assets right now, but 60% stocks is the appropriate number here, and that's where we're at. If you flip to page 22, just more information on returns, and this breaks it out not only over different time periods, but also the different major components of the account. So different time periods from left to right in the major asset classes from top to bottom. And so you see that top line 1 year return of the 11.22%. You can see the year to date, which is through June, of over 6%, and then 3, 5 in inception returns after that. And then you can see each of the individual asset classes, how do they contribute? And it's pretty clear that equities have had the lion's share of the returns, and that's what's been driving the portfolio as of late. Not even as of late, since inception. Equities have returned over 13% since inception. They've returned over 17% for the past year. And you compare that to, say, bonds, which are up only 1.5% since inception per year, and up only about, just shy of 4% over the 1 year. So having equity exposure, having the risk in the portfolio, despite it being relatively uncomfortable in certain times, certainly, and it's typically what's driving this portfolio higher. Next page, percentages are only helpful to some people. Other people prefer to see dollars and cents. And so the next page shows you, okay, the dollars and cents, what's been driving the portfolio's value higher, and to what extent. And so, if let's take a longer time frame, say 5 years, we can see that the accounts earned over $220,000 just in income alone, over those 5 years. And then market appreciation was another $320,000. So $540,000 or so of investment gains over the past 5 years. It's good, it's tough to complain with that. It's tough to complain. And I will say this is, it's a middle of the road level of risk in this portfolio, but even the equity portion, the stock portion of the portfolio is a lower volatility strategy, so it's not taking nearly as much risk as a lot of equity strategies might be taking. And despite that, returns have been really solid. Next page gets into some of the individual holdings in the portfolio. What's worked over the past year, what hasn't worked. In the top left on page 24, you see the top 10 performers over the last 12 months. Broadcom Semiconductor Company is the top performer, 88% return. We've recently trimmed and taken some of the profits on that. We still have a position in Broadcom. We still love Broadcom. But, it's been a good run, and you don't want to get greedy. So taking some chips off the table with Broadcom, reallocating into some of those securities that maybe haven't participated to that extent. Other notable contributors here to the portfolio, Progressive has been a great company. We did sell that one entirely. We took our profits. We redeployed the profits. Costco continues to crush it. Couple banks, Bank of America, JP Morgan, and so on. Bottom performers, mostly by virtue of the sectors in which they operate, as opposed to the company-specific performance. Healthcare hasn't been the best place to be, so Bristol Myers tops the list. Consumer staples, that's a relatively sanguine and safe sector within the economy and within the markets. And so companies like Nestle or Mondelez, they just haven't participated because their sector hasn't participated. And you'd expect that to quickly reverse if the market begins to slide a little bit. A lot of the money that's currently up in companies like Nvidia and big tech, a lot of that money will flow out of those performers, which have been exceptional, into the stuff that's a little bit safer, a little bit more secure, a little bit more stable. All in all, even the bottom performers, the vast majority of them we still own and we still like. Different assets will perform differently in different time frames, and you sort of want things to be lagging while other things are doing well. That's one of the components that leads to a smoothing of the portfolio's return. But yeah, everything we own right now in the portfolio is what we want to own. There's nothing in the portfolio that we don't want to own. It looks great. I'm almost done, so bear with me just one or two more minutes. So page 25. So we've talked about equities now. This now looks at the fixed income, the bonds, the safety of the portfolio, the ballast. And just a couple of years ago, bonds were really tough to buy. It was a tough pill to swallow, and a lot of institutions, whether they're town accounts or endowments or whatever, it's almost always the case where the investment policy statement requires a certain slug of bonds because historically they have been the safety in the ballast. But back in 2020 and even 2021, bond returns were just so low. It was a tough pill to swallow buying them. That has changed dramatically, right? Interest rates have skyrocketed, for lack of a better term. And so the bond portfolio is finally contributing. On a go-forward basis, one can use the yield to maturity as a approximation of what the bonds will return over the next 3 to 5 years, and that yield to maturity is about 5%. So that's meaningful. That's a positive contributor, one that's worth having. So it's not just about, no longer are we just including bonds for the downside protection and the safety, we're also including them because they're contributing actual growth to the portfolio. same can be said for bonds that I said for equities. Like everything we own is what we want to own. There's nothing in the bond portfolio that we don't want to own. Everything is investment grade, or virtually everything. We have a small slug of high yield, but it's relatively small. Ultimately, a really high quality portfolio. There's no risk of like defaults in this portfolio. There's no risk whatsoever. And if you look at some of the individual issues, you can see that on page 26 that we own. You know, you see some treasuries. Obviously, what typically are considered riskless assets with the fiscal situation in Washington. It's, I guess, debatable. But the U.S. Treasury is never going to default. They'll inflate their way out of the problem before they ever default. So U.S. Treasuries, we have some of those, and then corporates, investment-grade corporates. So Visa, J.P. Morgan, Amazon, Bank of America, you know, high-profile, well-known names. Fortress balance sheets, no question whatsoever that they will make good on their obligations. And like I said, there's a couple of other positions in here, generally through mutual funds, where we have exposure to things like high yield. We have a small exposure to emerging market debt. You know, basically that being like when Brazil issues bonds, that would be considered emerging market debt. And the Osterweiss High Yield Fund, a strategic income fund, is actually really high yield. It's lower quality companies that pay a higher coupon to compensate for the risk. But again, that's the small, sort of on the fringes type of positions relative to the core of the bond portfolio, which is treasuries and investment grade corporates. And on page 27, we show a maturity graph. So like, okay, we have a bunch of bonds, but when are they maturing? And you know, the way bonds work is at a certain maturity period, at a certain maturity date, you are assured to receive your principal back. And so you lend Walt Disney $100,000 at a 5% coupon. That might mature in 2028. In 2028, you're going to get your $100,000 back, and over the years up to 2028, you're going to get your, in this case, $5,000 of income each year. But so we have some maturities. Basically, this is roughly a ladder, right? So you have maturities sort of spanning from the relatively short term. Stuff is maturing in 2025. It looks like about $100,000, and then some in 2026, 2027, 2028, and so on and so forth. And one of the primary reasons you sort of stagger things like this and you build a bond ladder is because it's tough to predict what interest rates are going to do. And so if interest rates, say, move up from here, you want bonds that are going to mature very soon so you can take the proceeds and reinvest it at the higher interest rates. And so that would argue for front-loading all your maturities so that they do mature in, say, 2025 and 2026. But then the opposite could potentially happen, where interest rates fall, in which case you want some stuff that's locked in at the higher interest rate now, and you don't want to have it mature and reinvest it at the lower interest rate. So you do stretch some stuff out to 2032, 2033, and so on. Things look good here. I have no concerns at all. It honestly looks spot on.
It looks like a 7-year average spread here. I'm just looking at the.
Yeah. So one of the metrics that you use to sort of come to a single number that gives you a sense of your average maturity is called duration. Duration is at 4 years, and so.
And that's on page 25.
Yeah, that's back on page 25. You can kind of think of duration as many benefits, but one of them is it's an approximation of what your bond portfolio, how the value of the bond portfolio will change given a move in interest rates. And so what a duration of 4 tells you is that if interest rates were to move down from current levels of, say, 5% down to, say, 4%, they move down 1%. For every 1% move in interest rates, the portfolio's value will increase by 4%. That's how you can interpret duration. So duration of 4 is an approximation of the change in the bond portfolio's value given a 1% change in interest rates. 4% is right on top of our target. I'm sorry, not 4%. A duration of 4 years is right on top of our target. Our benchmark has somewhere around 3.9 years of duration. And so that sort of indicates we're neither making a bet for rising interest rates or for falling interest rates. We're sort of neutral on our interest rate expectations. Does that make sense?
Let me try asking the question.
Yeah, please.
If the average duration is 4 years,
Yes.
I would expect then never to see nothing in 2 years. That's very elegant, but I think you know what I mean.
Yeah.
There is no maturity in the graph for 2030 and 2031. So it looks puzzling to me. I thought it was the other way because it would appear that the recurring graphs seem to be 25 going to 32, 26 going to 33, but so I just don't.
You can kind of think of it like a seesaw, and this isn't a perfect analogy because it's more complicated than this. But if you think of where the fulcrum on a seesaw would be, if you were to draw a seesaw here, and some maturities are sitting on one side of the seesaw, and then you have the fulcrum, and then the other maturities are sitting on the other side of the seesaw. 4 years is the point at which it makes the seesaw balance. Okay, so the maturities that are happening south of 4 years are perfectly balancing the maturities that are happening after 4 years.
Okay, so this isn't an output measure.
An output measure.
I'm thinking that, I'm getting, at least I thought I was looking at, so much market value,
Yes.
I'm turning that into money,
Yep.
each of those years.
Dollars, yeah. Mhm.
So, I understand the balance thing.
Yeah.
I just, okay,
So let me another complicating factor in this is because it is really complicated. So you have certain bonds that are bullet bonds, and that means they're going to mature at a certain time at some point in the future. You have other bonds that are callable bonds, which means the issuer, the Walt Disney, can at any point say, hey, you know what, we're going to prepay off our debt.
okay,
That can shorten the duration without it being indicated here. So this bond out here, say in 2032, might be callable in 2025.
okay.
That callability can shorten.
Let me say, I'm ready to roll on this. If I remember the size of this in the portfolio was 3 or 4% of bonds.
Oh, no.
No,
30.
it's closer to 30-35%.
The cash is what.
Yeah.
Yeah, the cash is the 3
Oh.
or so percent, yeah. Yeah, the bonds are a significant slug in the portfolio,
Okay,
yeah.
all right.
Yeah, but I wanna make sure that you're comfortable with what I'm.
Oh, I don't want to be comfortable. Yeah, go ahead.
So
Okay.
if that's, quick question, so
Yeah.
if that's, we're looking at that as a fulcrum of things balancing out,
Yeah.
then obviously without the graph continuing, we would expect some maturity in 34, 35, maybe even 36.
Potentially,
Assuming things
but
aren't
again,
called early,
you
things like that.
can't take this for face value because that tall bar in 2032, if that's callable, you kind of have to take some of that bar and put it back over here on the left. You know what I mean?
Okay.
What's most important here, the sort of the takeaway here is that the ladder, the fact that we have maturities at different years throughout the next 10 years, and the duration of the portfolio indicates that we're not making a big bet on interest rates. If we were going to make a big bet and we said, hey, you know what, we're 100% sure interest rates are going to come down from here, we would be front-loading, we would be backloading. We would be pushing as much stuff out as possible because we want to lock it in.
Last as long as
Want
you
to lock it
can.
in, right? It's like you're choosing between buying a 6-month CD or a 5-year CD. One of the things you're asking yourself, well, what are interest rates going to do? And so we generally don't play in the interest rate prediction game because it's a remarkably difficult game to play. We will around the edges, but we tend to stay relatively close to our benchmark duration. And that's where we're at right now. We're basically right on top of our benchmark duration. We're not making any big bets. Whether interest rates move south or move north from here isn't really going to bite us either way.
Thank you for the breakout.
You bet. Yep. There's nothing really much else in here. There's a bunch of like holdings reports. You can see all the different holdings. There's somewhere in the neighborhood of like 45 stocks being held. There's probably 7 or 8 mutual funds, and then like we saw, the individual bonds. You know, not only is this a matter of diversifying across names, across the Visas and the Disneys and all that, to mitigate some of the company-specific risk, but we are well diversified across economic sectors. That's one of the things that we strive to do, is having a little bit of money in each segment of the pie, because inevitably in every single market there are always going to be winners and there are going to be losers, and there's going to be winning sectors and going to be losing sectors. Right now the winning sectors are technology and communication services. Communication services is basically where Facebook lives and where Google lives. So really it's all technology. Those have been the winning sectors. We've had exposure to those. They've certainly contributed to the portfolio. But there have been some laggard sectors, things like real estate, utilities, consumer staples. Despite the fact that they haven't performed as well, we wouldn't just eschew them and get out of them, because they will also have their day in the sun, and that day would probably come when the economy begins to weaken.
Thank you. That's where, so as Brandon said, we have a number of these charts for reference, and sort of that's where this chart comes in to indicate that, you know, what may be a high flyer in one year,
Yeah.
you know, could be a bottom performer in the next, and that's why it's important to stay invested across all those different asset
Can you
classes.
tell me the page
Sure.
number?
Yeah, I can just hold it.
Page 19.
So this
yeah.
looks like an eye chart. It looks way more complicated than it is. Really, all this is that each color box for a given year, which is a column, each color box indicates a different sector of the market, different segment of the market. There's a cash box, there's a high yield bond box, there's a large cap stock box, and so on. And so what I typically do is I just ignore all but one color. All right. So let's take large cap, which has been the high flyer this year and last year, and ignore all the other colors and just look back in time at where that light green box is. Sometimes it's at the top, sometimes it's in the middle. It's very rarely at the bottom, to be honest. But then there are other asset classes, commodities, dark green. Just phase out all the other colors and look at dark green. Dark green is all over the place. Sometimes it's at the bottom, sometimes it's in the middle, sometimes it's at the top. That just sort of indicates that there's not just one segment of the market that anyone wants to be invested in, right? Depending on the scenario, depending on the environment, where we are in the economic cycle, different parts of the markets will perform better than other parts, and it's one of the reasons that we tend to not make huge and sustained bets on any given part of the market, because what was great to own last year is oftentimes not great at all to own this year.
Yeah, and then, as Brandon said, I can talk a little bit about income. So, of course, you do have a fairly large income balance right now that's sitting, it's in money market to be sure, so it's earning 5+%. But the majority of that is made up of the cemetery fund income position. Of course, we have to keep that segregated on the MS9s because that's what you have to spend in the trust funds. And so, you know, it's effectively, as Brandon said, it's sitting there, it's, you know, kind of overweighting cash at this point. But you do have a couple of options if you want to explore them. As Brandon said, and I've observed, we don't spend a lot of the income. You know, we had that 17.5 distribution from the cemetery fund last year, but it's still got a very large income balance. So what a few of our other towns have done, they've done a couple of things. We can buy an asset, an actual asset, and it would probably be some sort of fixed income asset, whether it's a treasury bill or a bond or something like that, CD, in the income portfolio. And so it would stay in the income portfolio. Some towns, if they don't believe that that income will be used immediately, they might transfer a portion, just a portion, not the whole thing, to the principal portfolio for investing in the general pool of assets. So we would continue to maintain the full income balance on the MS9, but reflect that a portion of that income balance has been transferred to principal for investments. So those are two options. Both have been done and have the blessing of the authorities at the state, at the charitable trust unit. So they're definitely possible if that's something that you want to explore. So.
I have a question on our end, Justin. Do the trusts specify like what can and cannot be reinvested in the manner that she's talking about for option 2? That's something that.
So this is mainly the cemetery trust.
Mm-hmm.
It would be state legislation that would determine it.
Okay.
As you mentioned, it's usually only a small portion that you'd be doing that with. You wouldn't throw the whole thing in there.
Right.
But
And again, we're not spending it,
Right.
we're simply investing it.
Some trusts are very more
Yeah.
particular than others,
Sure.
if I remember correctly.
it's, and
As far as
correct me
what-
if I'm wrong on this, my understanding is essentially you're not actually spending it,
Mhm.
but it's acting as such, so if it does, although you have to do it in fixed income safe things, so it's not actually a risk.
Mm-hmm.
But it's allowing you to get higher interest yield and higher earnings on it compared to where we're at now.
Well, and let me just stop you right there. So
Potential.
you wouldn't be earning more to invest it in safer securities than you do now, and so I wish this was a little bit cleaner, but this is the yield curve. All right, so this different maturities from left to right, shortest maturity here, and this is stuff that doesn't mature for 30 years. The yield curve is inverted, which means that short-term interest rates are the highest point of all the maturities. That's atypical. Typically, as you would expect, if you're going to lock up your money for longer, you want to be compensated for it. So that you typically have a positive sloping yield curve. That's just not the case right now. And so we are in cash earning this. If we were to choose to invest some of it in safe, usually it's treasury securities, you'd be earning something closer to, here or here or whatever. The only reason you would do that is because you think this is going to come down in a meaningful way, which it will come down in a meaningful way if the Federal Reserve begins cutting interest rates, which there's been so much speculation around. So it's a matter of locking in a yield that you are comfortable with for the longer run, despite the fact that yield is lower than what you are actually currently earning today. What you're earning today might be significantly lower in 3 months. We just
Yeah, nope, it
Yeah.
makes sense. I was looking at it more right now are the town's general fund, things of that nature.
Yeah.
Because we have everything that goes against it and all the expenses that go against it for the bank, we're earning about 3 to 3.5 in
Yeah.
that, where the CDs that we put it in, we're getting 5.2.
Mm-hmm.
So for 1, 2 month, 3 month, 4
Yep.
month, 5 months,
Yep.
it's better for us to do it in that aspect because we're getting more interest during that time if we know we're not gonna need it. I
Right.
was looking at it in that. I
Okay,
didn't-
sure.
Yep.
If we're getting it now, but as he was saying, that's essentially what he said is a lot better than what I said.
And that's obviously-
And that's why we pay him to do this.
Yeah.
Right, but all in line with our investment policies, ultimately, if
And
that's gonna.
I mean, from what I've heard, and they can correct me if I'm wrong, I think it's up to about a 75% chance the Fed's cut in September.
It's closer to 100% now.
So doing this may not be a terrible idea.
Yep.
Because we're getting that now, come September, we don't know where it's gonna be. And you don't know if they're gonna cut, is the next one in November or December?
It would be. I think it's December 12th is the next one after that.
And there was at one point talk of 2, I don't know if there still is or not.
There is still some talk, but I will say that the market has been expecting the Federal Reserve to cut interest rates for the past 18 months.
Right.
And it just hasn't come to fruition. It's just been one meeting after another where they just Federal Reserve keeps saying, nope, now's not the time.
Canada finally doing it, I think, though.
And a lot of other economies around the world are. It's a balance, right? If you cut interest rates too quickly, you respur inflation, which is always the risk, and that's what's happened historically, is they've cut interest rates too quickly, inflation starts to spike back up again. Jay Powell just wants to ensure that doesn't happen, so he's been really slow to make this transition. To his credit, I think it's been the right decision. And there's nothing to say that if they were to cut interest rates in September or even again in December, if they wouldn't have to quickly reverse course. It's very much in the realm of possibility.
I don't know if that answers your question or not.
Yes, very
Yeah.
much so.
Yeah, and so how many dollars and cents are we talking about in the?
I think about 200,000.
Is it that much?
Yeah.
Oh,
And I
pocket
mean,
change.
we'll be,
Yeah.
Right?
we'll be filing a
I love
request,
that pocket.
just so
Well, it's
you're
not-
aware,
it's
for about
compared to what we're
sitting on.
just
It's
under
fine.
30,000, which isn't much, but
I'm sorry, what?
we're
what
gonna
was
be
it?
filing a request,
Okay.
assuming they approve it,
Mhm.
for just under 30,000, which
Okay.
still isn't much, but,
Okay.
Okay,
but if
But
you're
it's
looking at
something.
200, it's
Not
a
too, it's
percentage.
150, it's gotta be about 150, because we have 197 in total, that
Oh, okay.
includes the
Yeah.
stuff that's in the principal portfolio.
Okay.
Call it around 150, 160 in the income portfolio, taking 30, now it's down 130. It's not a game-changing decision one way or another,
Mhm.
it really isn't.
What's your rationale?
on doing this.
No, on the 30 specifically.
It's 25 for the annual maintenance for fiscal year 25, and then it's another 1,700 for repairs on Pillsbury Cemetery that we received.
Thank you, appreciate that.
So 26,700.
Yeah. Okay.
Thank you, thank you. Great.
Yeah, so, you know, we could take 50 or 75 or something like that and you know, put it in some sort of longer term, you know, fixed income security to just, as Brandon was saying, just lock in that rate. So, but again, entirely up to you all, so. And if you wanna think about it and get back to us, that is also completely fine.
Absolutely. You guys want to discuss it, and I can email them, or do you want to discuss it now while they're here? It's you guys are the ones that are the decision makers on
Do
this.
we want to, especially if we're saving the second part of the meeting for like administrative business, do we want to just kind of continue it into that? We can make a motion as appropriate, that can be
Yep, and then I can
communicated.
inform them, yep.
Any objection to that, or do you want to
No,
make
I
a
have
decision
no
right now?
objection, I just have, if somebody will tell me the wording is, I should best use to propose the motion, I'd feel a lot better, because,
We don't have to propose a motion to do it then, we can just do it at that point.
oh, okay, so we just have to agree.
Yeah, because they're presenting to us right now and just
Okay.
giving us information for what's happened over the year and what they're recommending or what we're capable of doing in the next year.
Yeah, it meets our mission, maximum return for minimum risk.
I mean, if we don't need to go through the process of the motion, I'm in agreement.
Well, oh, no, I meant a motion I thought he was asking for a motion to postpone it until after they leave.
Oh, got it, understood.
All right?
So we will, we'll discuss it and get back to you.
Yeah.
all.
Sounds good.
Yeah, no problem.
Thank you for the
Alright.
overview today.
Yeah,
Good,
you bet.
absolutely. Happy to do it. Good to see
Don't
you
imagine the
again.
discussion will be too long afterwards.
Right, yeah.
Do you have any idea of what the rates would be roughly?
So if the Federal Reserve cuts interest rates, it'll be by 25 basis points, right? So right now, the Fed funds rate's at 5.25, go down to 5, so you lose 0.25%. And if they did it again in December, it'd go down to 4.75. And
I meant for, if we were to,
If
say,
we were to
put
invest in-
50,000, what the rate
Oh,
would be.
well, it depends on how far out you wanna lock it. So right now, the only thing earning more than 5% is a security 6 months or shorter, right? So I don't really see any purpose in doing this for a 6-month maturity. I think if you're gonna kind of lock in an interest rate, you should do it for probably 2, maybe even 3 years, depending on what your, depending on how far out you can predict distribution needs. And so at like a 2 or 3 year, you're probably in the neighborhood of like 4.5, 4.6%.
Okay.
So it's a relatively significant drop off from the current money fund, which is around 5.2%. But you
But you're
have
guaranteed
that
at
exactly.
best.
You're locking it in.
Yeah.
Yeah, exactly. Yeah.
It's a lot more enjoyable talking about being able to do it for 2 to 3 years, because operating, I can only do it for the longest it's a year.
Mhm.
So,
Right, of course.
Yeah.
at that point, the
Yeah, I for sure.
6 month or shorter is what really
If we're
makes that
talking
drive.
like, if we're talking you have about 150-ish in income portfolio and you're gonna be taking 30s, now we're down to 120, you'd want a sum of that, maybe half of it,
Mhm.
still remaining in cash
Yeah.
for that unexpected distribution that, because you don't wanna have to sell a bond before it matures, because you might be getting less than what you put into it, it's possible. The only way you're guaranteed to get what you put into it is if you wait for maturity. And so really we're talking, you know, maybe putting $50, $60, $70,000 in the bond and then the rest keeping it in cash. And that's why I don't really have a strong feeling one way or another. I wouldn't make a strong argument one way or another. It can't hurt to lock it in if you're comfortable losing a few basis points on the return for that, in exchange for that security. But if you say, hey, you know what, let's just keep things simple and leave it in the money market fund, I don't see interest rates falling, collapsing down to, 1% again anytime soon.
Thank you, Fred.
All
Yeah.
right.
Is there anything else we can do for you
Yeah.
guys?
Any other questions? Thank you guys so much for coming in.
Yeah, thanks for having us.
Absolutely.
Nice to
Great
see
seeing
you
you
guys, thank you.
Thank you.
Appreciate it.
Thank you for coming out once again.
Yeah, my pleasure. All right. Have fun with the rest of your meeting.
Absolutely.
And if you have any problems sleeping at night, bring this into bed with you.
It'll put you right to sleep.
You know, you need some reading in the bathroom.
Yeah, right,
Yeah,
yeah.
that's the stuff right there.
Yeah. All right.
All right, thanks for having us, Justin.
Absolutely. It's great seeing you again.
Great
Thank
seeing you
for
again.
the
Great meeting you.
opportunity.
Thank you.
Thank you,
Good
folks.
to see you
Appreciate
again,
you.
yeah.
Good seeing you again. Good
Yep.
to see you again, Jonathan.
So, excuse us.
Hi.
All right, and Brian.
So,
Nice to meet you. Thank you.
Take care.
Enjoy the rest of the summer, guys.
All right.
Thank you, folks.
Justin.
Good seeing you again.
Yeah.
You know you're
Yeah.
looking up.
Sounds good.
Thank you.
All right.
Okay, let me get reorganized here. We're gonna start with your fund packet, and I'm gonna give you the same old spiel that I always go. Please be careful, hackers have done a lot more with a lot less information. Thank you. And as always, if you want, I can, go ahead and take it and shred it afterwards if you want.
Can we, the gentleman opposed to, well, it's still fresh on, well, their briefing is
Yes,
fresh on the
absolutely.
brain before we get into
Yeah.
the 30-day overview and relative orders from the council. Did we want to discuss in motion on what was just proposed to us regarding securing some of the cash? Anybody have any particular thoughts in that regard? Or what they were just proposing, taking, was he suggesting a higher amount than you recommended? To put?
He was suggesting, no more than half, essentially, is what I got from that.
So you had recommended around 27,000, he was suggesting closer to like, no higher than 70 or 75, is that?
He was, so right now we have about 150, we're gonna pull, I'm just gonna use 30, so it's an even number, down to 120. So 60 or less. And I mean, from what he's saying, it's right. And obviously he's right. But you're walking in, and that's one of the reasons I wanted to ask about the interest rate, to see what it potentially could be. You're walking in 4.5%, 4.6% over the next 2 or 3 years. We know it is very likely, it's more probable than not, whatever percentage, or, with the little asterisk next to it where it's not 100%, they're likely gonna cut in September, bringing it down. From what I've heard from him and other bankers is December is still up in the air, and it's likely gonna depend on how the economy reacts to the cut in September. So if they do that, let's say they do both, you now are at 4.75 for the Fed rate, which my guess is you're likely to get 4.5 around there, which is roughly what you're getting for 2 to 3 years. Where the benefit potentially comes in of securing it is if something happens where they cut it again in another year. So next September, because now all of a sudden you're now at 4.5, but you're locked in at, the Fed rate is now at 4.5, you're likely gonna get 4.2. but you're locked in at that 4.5 from before. Where it's such a minimal, it's up to you guys whether you want that safety of getting it. Because there's also the other aspect of they cut it September, things act well, election happens, they cut it December, all of a sudden things go crazy and they try to slow inflation and they bring it back up, where now we're locked in at 4.5 and the interest rate is back to 5. So it really depends on what you guys want to do in terms of that aspect. If you want to lock it in now and assume things are gonna work out well and go that way, or we don't have to decide this. You don't have to. I guess the best way to put it is, this deal doesn't go away. The interest rate may drop, it may increase. That may happen, but after the rate, we could reach back out and say, hey, what is our current cash rate? What's the current 2-3 year rates, and make a determination at that.
We're still only talking a portion of cash, which is still only a small portion, very small portion of everything we're managing.
Right.
So
And
that's what you're saying, is that, it's not a decision to essentially lose sleep over. Is that kind of what we gathered?
Exactly, and you look at it, and we historically haven't really spent much more than, this year is the highest year we're drawing on the income. Because last year, if you remember, we increased from 17.5 up to 25, because the contracts for mowing and the maintenance and everything went up. The fences are deteriorating, so that's why we have that 1,700 one. We have a much more active cemetery group, so we may be drawing on it more and more. But to say we're gonna draw 120, and that's not including the income that grows on what's currently in there, I would say we're not gonna draw that amount, and I mean, knock on wood and everything else, we're not gonna draw that amount within 2 years. But the amount we'd gain versus the amount we'd lose, I wouldn't lose sleep on it, if that makes sense. Where I'd lose sleep is if it's a significant amount either way, or if all of a sudden something catastrophe happens and we no longer have that money liquid to be able to pull from. In which case, we'd then have to break the bond and deal with the penalties and all that.
Now, were they mentioning a comparison between the bond and a money market?
So that's, the money market, I think you said we were getting about 5% right now.
Okay.
So the cash is sitting in a money market getting 5%.
Mhm.
A 2 to 3 year bond is between 4.5 and 4.6%.
Okay.
But that's locked in for the entire lifespan, where COVID happens,
Mhm.
that 5% can be 0.
Okay.
If that makes sense.
Yeah.
So looking at it, let's pretend this decision happened back in 2020.
Mhm.
Right now, it's January 2020, we're getting 5%. Or February 2020, we're getting 5%.
Mhm.
We say absolutely not, no point in this, 5%, it's amazing. May happens, that 5% is now 0, where we could have locked in 4.5, 4.6%.
What would drop the money market to 0? I guess I don't follow.
That was a dramatic, extreme example.
Okay.
Essentially trying to say the 5% isn't guaranteed.
Okay.
So it's 5% today.
Mhm.
After the cuts, it won't be 5% anymore. It'll be 4.5 or something like that, which is still within this realm, which is why it's not.
So it almost tracks that, but we could lock into this versus the money market, which,
Depending
could
on.
the money market go up?
Yeah,
Okay. As opposed to this, we're locked.
correct.
Okay.
So that's essentially where you're getting the security of knowing you're getting 4.5. Let's assume they cut both times. So you're now at 4.75. That's, we're in July, let's say August, so that's 4 months out. You still have another, if we go 2 years, you still have another year and 8 months of needing interest rates to stay where they are for this to be a wash. Depending on what interest rates do, depends on whether this makes sense or whether this is beneficial. Because we could tie it up and interest rates could go up, and then we have money sitting in a lower interest rate bond than what we would be getting in cash. And I mean that, speaking in terms of the town during the COVID aspect, it made more sense to put money in money markets because the CDs, not directly COVID, but shortly after, because the CDs weren't giving interest rates that were better than what we were getting from high yield savings, money market, all that. Where now, I'm looking at it, and as he mentioned, 6 months and under, you're getting above 5% what we're making in cash. Right now, the town, our policy, you can't do more than a year. So we locked up money for 1 month, 2 months, 3 months, 4 months, and 5 months, depending on the cash flow. Where we have the benefit here is the cash flow is $30,000 this month, and then another 25 in July of next year, pending maintenance and everything else that could go wrong in the cemeteries. Because I mean, from my understanding, and you guys are the trustees, you can tell me if I'm wrong, this funding can't be used for growing the cemetery. It has to be used for maintaining the cemetery, if that makes sense.
I think that's the discussion and the conclusion we've all come to
Yeah.
before. I don't think we made any examination that kind of determined otherwise.
So like Pillsbury Cemetery, for example, we're expanding it, we have that capital reserve. This money can't be used for that. But at Pillsbury Cemetery, one of the fences was broken down, and we're requesting the money to fix that fence.
Now, once that work is completed, this can be drawn upon for the upkeep and maintenance for the expanded portion.
Correct.
Very good, very good.
It's,
So
you
so
can't
ultimately, it will benefit the expanded portion, it just can't be used for,
to expand it.
got it.
And again, that's my understanding. I very well could be off on that, and if I am, by all means, let me know.
So when we paid for our plot,
Yes,
does that money go into the trust fund?
it does. And the income that is earned on that is what we're discussing now. So your payment for the plot doesn't get touched. That stays there, and that will stay there in perpetuity.
No, I think I was feeding off John's comment, if it expands, maybe I didn't understand, but it sounded, well, I guess we had the potential that we were using the same money that we've had for, say, X number of plots was now covering X plus 25 plots, but the money for the plots themselves would go into the trust fund to help maintain those. So when
believe-
I'm buying a plot, I'm not just buying land, I'm buying future maintenance on that.
I think, yeah,
Is that-
that's
I
a
think
good
that's-
pickup,
yeah.
Okay.
Yep.
I think you stated it better than I did perhaps, but yeah, I think we're,
Well, we just invested in a second property in Londonderry. Was one of those.
got a little extra land grab. Well, we have a investment policy that says we're supposed to attempt to reasonably grow what we have, which we seem to be doing across different areas. It also allows for us to be conservative in protecting the assets of the town that we're investing. It seems like we'd balance out both of those approaches if we took some of this cash and kind of tied it up as they had recommended.
Yep.
Does anyone feel otherwise? What are your thoughts?
Yeah,
What do we-
it sounds like not a risky bet.
Okay. Do we,
I mean, this is where you don't have to do 60. You can do 10, you can do 20. It doesn't have to be the full half. You can, whatever you guys decide, if that makes sense.
do you want to go with Justin's recommendation of 30K
Yeah.
as a round number?
So
a
that,
motion to that effect to,
before you vote on that, just so we're all on the same page. So if you go to this page, it's in here. I think it's, I don't know what page number I have in there.
Oh,
Yeah.
okay.
Okay.
What was it?
It's,
Second.
whoop, this guy right there.
Oh, sorry about that.
No worries. So flip to the second page on that, and you'll see there is a cemetery line.
Oh, okay.
And I mean, here's the other thing to keep in mind too, looking at where we're at now, the cemetery's investments this year earned 45,000, almost 46. If you look at the total income for end of the year, you're at, that's where the 150 number's coming. So using round numbers, we're gonna be taking 30 out for, it's less than 30, but let's call it 30 so we can have the round numbers, if you guys are okay with that. That knocks us down to 120. If we take out another 30, that'll knock the income earning cash down to 90. Just so we're all on the same page and I mean, the 30, like I said, it doesn't have to be, so that before, after the 30, we're gonna be withdrawing for expenses. You're at 120. He recommended not doing more than half. I emphasize that as well. So 60 would be the max that I would recommend. I personally am not sure I would do 60. 30 is kind of a nice balance, because it leaves 90 in there, and assuming that we have similar returns, let's say the interest rates drop a little bit. Actually, this isn't based on interest rates. This is based on the earnings from the principal, which is invested in all the stocks, everything we went over. So let's say that stays around the same, even drops a little bit, you now have earned 40,000 next year, which covers the 25 in annual maintenance fees, and leaves some in there to grow.
Now, if we did something to the effect of 50K that was invested, that would leave about 100 in there as cash earning in the money market, is that
70, because we're gonna be taking out the 30.
indeed? What would be, that's what I'm saying, what would be the effect if we shifted the 30 to 50? Is that too high in your opinion? I know you said 60 is kind of on the cap end. Is 50 still too higher than comfort in your financial opinion?
So where we've
just
been
curious.
drawing,
Like, that sounds like round numbers to me, but I'm not trying.
nope, it's
just curious.
150. Sorry, just wanna make sure I'm doing this out in my head. I'm gonna write it down if you don't mind. So 50 puts us at 70. So next year you're gonna minus 25, be at 45. Assume that you earn 40, you'll be at 85. 50 wouldn't be a terrible. It's where it comes in is, because it's a 2-year, and I guess the best way to look at it is, let's say we earn nothing. For whatever reason, the stocks stay flat. You lock it up for 2 years. If we do 50K, you'll have 70K income earned on cash. Next year, there'll be another 25 request. That's covered with the 70. You then have the second year, 25, you'll have 20 remaining. And then if we do a 2-year, that lapses in, you get that 50 back. So if the next 2 years, it earns nothing, you're still able to cover the annual maintenance that we do.
That's
That's-
not counting anything catastrophic happening at one of the cemeteries.
Correct.
It sounds like that may be a little high for comfort and leaving us cash in case something.
And I mean, that's
catastrophic
worst case,
happens.
I wanna be clear, that my mind always goes, worst case,
Sure.
things get 0. I'd be willing, there is limited to no way that you're gonna earn 0 over the next 2 years with your $1.1 million balance. But that's kind of where my mind goes with this is, if worst case does happen, where do we stand?
Would 30 leave us more of a cushion for?
30, if nothing were to happen?
Yep.
If nothing were to be earned, that 45 would jump up to 65.
Okay.
And again, you have the worst case, or the absolute worst case in that situation, you break the bond, take a little bit of a loss to get that money back liquid. If that makes sense.
Again, that was your original recommendation, was the 30?
My original is less than 60.
Less than
The
60.
30, I think we're getting confused with the 30 we're taking out for the expenses. But it's a nice round number, and it works in terms of, you look at it and we're at 120, it works in terms of, I don't know, for some reason, those are some of the numbers that click for me is 30, 60, similar to 25, 50.
That does seem to leave us more of a catastrophic cushion than if we
Yeah,
increased it, so.
It's a nice halfway.
And I mean, here's the other thing too, is, let's say you go with the 30, you can revisit this in however many months and say, all right, well, let's do another 20. If that makes sense, where it does, I mean, you can do 10 now and then essentially see if we can,
Okay.
it's up to you if you wanna kind of spread it out as well.
Because again, even, excuse me, just like say the 30 now, and then see what the election brings, what
Right.
either stability or chaos the election could potentially bring. But we
Right.
can revisit that for a higher amount at that time?
So the 30 would be locked in,
Correct,
but you'd be able to
We
use
could
that
go
remaining
additional.
income, yeah.
Perfect.
Which is gonna keep gaining, and then if things go favorably after the, let's say, the rates do climb, then, you know, that's separate funds that we could invest even at a higher rate if things were to go constructively.
Mhm.
I'm in favor. What are your thoughts?
Yes.
What would a motion to that effect sound like to empower you to?
To authorize me to instruct Cambridge, do you want 2 or 3 years?
What are our thoughts?
I was thinking originally 2.
Okay.
Again, any recommendation on that also?
That one I'm not 100% sure because it's, we'll put it like this, if 3 years 4.6
Mhm.
and 2 years 4.5, I'd go 2 year, that 0.1 is not. Getting it liquid again, in case something were to happen, is more important than that 0.1 is gonna earn me over 3 years, if that
Okay.
makes sense.
Mhm.
But that's just, they gave us the range in that aspect, so. But it would essentially be to authorize me to, request Cambridge take 30,000 out of cemetery income earned and invest into a 2-year bond.
So I would make a motion to empower Justin as our bookkeeper to work with Cambridge Trust to take 30,000 from the cemetery income and to
2-year investment, let's say.
place that into a 2-year investment.
Mhm.
Could we cover all the appropriate
I
bases?
believe so, just in case, I said bond, I'm not 100% sure if it'll be a bond or a CD,
Okay.
and I don't want that to be the hang-up where now all of a sudden we have to wait and rates get lower and all that fun.
Sure, so
Yeah.
the motion is to empower Justin as the bookkeeper to work with Cambridge Trust to take 30,000 of the cemetery income and to place it into some 2-year investment.
Second that?
Okay, we are all in favor?
Aye.
Aye.
Very good.
Perfect.
I heard you on your concern on how we would construct that. It took me a minute to formulate it in my head, even with his assistance also. So I think we covered all the bases, though.
I think so. Because that's where I was hesitating too, where it's, well, I don't actually have the authority, but if you're authorized, I think we're good with that. All right, next thing, we're gonna do this. And see if we can improve how I did it last time. So, this is a request to withdraw from the fire department equipment capital reserve.
Thank you.
We're gonna do, these are all separate requests.
Oh,
So we wanna do one at a time?
yeah, I feel better doing them
Yeah,
one
okay.
at a time, good with you?
I'm agreeable.
So look at it.
So this is a council order that, yep, we previously did back in 2302. We spent, it was authorized for 173. And we've already spent 117, so this is the remaining 44, or not remaining, but an additional 44 on that withdrawal. So when we get this and you guys authorize it,
Yeah.
we pull it as we spend it rather than pulling it all and then spending it. That way it stays in the fund and earns a little more interest to move forward.
And that is 2023-02. Any discussion, any questions?
No, I think. Yep, no, that sounds,
It's the account that's coded.
This, so what we've done is, we've spent this money. We've already paid the vendor because we
Yeah.
received it. We charge it to this account, so we track it.
yep,
And then once you guys authorize the release, we will transfer this to the expense and reimburse the general fund for. This allows us essentially an easier way to track it.
Sure.
I motion we approve that. The transfer, sorry. I motion that we approve the withdrawal of the 44,791 for the purposes of this invoice.
I'll second that.
Agreed.
Good?
All right, all in favor? So
And then if you guys want to
2023-02.
just sign that one.
Okay. And we sign these now, John?
Yep.
25th?
Yep. And this is again just a way for us to, we created the cover sheet just as an easier way for us to track it in finance.
Thank you.
The next one,
Just
so,
indicate at the bottom.
oh, yep.
Okay.
Do you guys feel it meets the intent of the fund? It's fire department oh, which, by the way, hold on. In your packet, you should have, I'm gonna try my best if I forget one meeting, please.
The relevant article.
Yep, the relevant article establishing it. So it's gonna be this one, the one without the big black mark.
Was it Article 6?
Yes.
Okay. Oh, there it is.
I already motioned to pass it, but I do think, upon retrospective look, that it meets the intent of the
Okay.
capital fund.
I apologize for that,
Not at all.
as I've mentioned, by the time this gets to you, in this case, the fire chief has reviewed it, my controller has reviewed it, I've reviewed it, town manager, the town council, so I'm usually a pretty big stickler on, no, this doesn't work, or I tell them they need to come and defend why it does. All right, so the next one is again, all of these, with the exception of 3, are gonna be the fire department equipment capital reserve. So this is from Council Order 2311.
Patience.
Sorry.
No, I'm not. It's 202-311.
Yeah.
Curious to see
Yeah,
that.
we'll go over that.
Thank you.
Oh.
Okay.
at my decimal point off. Okay. Just $520
Mhm.
for,
And this is a guarded hood, which my understanding is, so before new firefighters, this is protective gear for them. Right. So, no, this is not protective gear for them, but it is protective gear for firefighters. The 4 is just a coincidence number.
and that's out of the same
Same fund.
fund as before, so that. Okay. Good.
I propose that it meets the intent as we just examined. Very good. I want to do a motion to approve 2023-11 for the fire department equipment categorization.
Second, yeah.
Okay, and everyone's in favor? Very good.
Pointy end down.
The next one is, again, fire department equipment reserve. This is for a global jacket, pants. And this is the invoice here, if you want.
What council order number is that?
This is 2023-16. The total amount was for 136 and change. We've already spent about a little over 110.
Did you get a chance to?
Yeah, I'll
Yeah.
just take a photo for it. Thank you.
All right, very good. We feel it meets the intent of the fund.
I do. Second or?
Very good, very good. All right, so I'll do a motion properly to approve 2023-16.
Second?
All right, everyone's in favor?
Sorry.
Alrighty, we have another fire department equipment. This one is Town Council Order 2024-06. It's for a variety of
Okay.
fire items. I'm not gonna pretend like I know what they are, but it's an infusion pump, wireless battery, that's just the additional, and software license for Spectrum, which likely is, not likely, it's a Spectrum IQ infusion pump, so the license,
So everyone's equipment.
yeah, the license to use that.
I don't know a lot about firefighting, but I know infusion pumps.
Yep. Since starting here, I've learned a lot more.
and I think it meets the intent.
Agree?
I only wish we could get the goal, no.
Very good, very good.
Yeah.
Do you want me to make a motion again? You want to?
Second.
Okay, I'll make a motion to approve 2024-06. Any seconds? We're all in favor?
All in favor?
All right, very good.
And while you're waiting to sign, this next one is the cable equipment reserve. It's the one if you want the establishing of it, it's the one with the black mark on it.
It's order number.
This one is 2024-10.
What's the establishment of that fund? Establishment?
No, this is, if you're working for the establishment detail. And this is actually the town and school have an agreement that this is, if you guys remember the warrant article, I don't remember the number off the top of my head, but it's the one for 32,500 to put money into the cable capital reserve that comes from Comcast as part of the Comcast agreement. We have an agreement with the school district that we send them $8,000 for them to maintain their, is it WEO? The WEO side of the cable access.
Okay. That's this article here, 5.
Do these have to be signed by them, or?
So the real copies are,
Oh, okay.
these are just, yeah.
This article here.
Okay, good.
Yeah.
Okay.
Say it meets the intent of the article.
Did you mention something about 32,000?
So that's, we received from Comcast as part of our arrangement, 32,500 for the purpose of public access television, some weird language on it.
Okay.
But it's, the reason I mention that is that's the warrant article that you'll see every year that has a zero impact, that a perfect example of having to do things just to do them.
Okay.
Is, we have to have that even though we're getting it from an outside source and it can only go to that purpose. So we have to put it in there if we want to put it in the capital reserve. So a capital reserve essentially, you need authorization from the public to put money in. So even if it's, say you pass away and you wanna, hey, I wanna donate $100,000 to the fire department to put in capital reserve.
Mhm.
We have to get approval from the voters to take that money and put it in. I don't know what would happen if they said no.
Okay.
In this case, I think the money, we'd either have to spend it immediately within that fiscal year, or we'd have to give it back to Comcast. I'm not 100% sure on that, but that's my understanding up to probably about 90%.
Thankfully, the voters have never rejected that. Huh? Good.
Absolutely.
In good faith.
Exactly.
Very good, very good.
Yes, and this is just a withdrawal of the 8K.
Yep, so we send it to the school district.
Okay, even though the total expenses is 100 more, that'll come out of the regular
That will come out of their cable,
cable.
not ours, theirs.
Okay.
In agreement, all seems in order. I make a motion to approve 2024-10.
Second?
Okay.
Third.
Everyone's in favor? Very good. May I?
Yeah.
Or you can first.
This next one is, the annual contribution from the cemetery trust fund to the town to assist with the cost of maintaining the cemeteries. With this,
Give me that
It
breakdown again, I'm
looks-
sorry.
what?
Give me that breakdown again, I'm sorry. I
So-
know it's relatively simple,
Nope,
it's
you're
just.
good. This is the annual contribution from the cemetery maintenance trust fund, the income, to reimburse the town for a portion of maintaining the cemeteries. That way it doesn't fall entirely on the taxpayers, but rather the fund that is intended to maintain it.
Sort of council order.
This is not. So this is the one last year, if you remember. This one, I believe, is it's either in your guys' authority or the cemetery trustees' authority. So I get approval from both of you. That way
Yes.
everyone's aware, and there's no surprise that, hey, the cemetery trustees spent X amount, what happened? Or you guys spent Y, and the cemetery trustees think that they have the full balance and they don't.
We
One of
still
those.
never delineated who's actually responsible, so we still just capture both approvals to be on the
It-
safe side.
Well, it's one, I could look into it, but I'd rather wait until there's an issue where one of you disagrees. I'd rather have everyone aware and be on board with it, and once someone disagrees, then I'll take a look into it. But where people being aware, and I think of it as net, if that makes sense, where getting them approval and your approval, it doesn't, I don't think it hurts. Just my thought on it, so that's why I do it. If you look, I actually have their approval back from their last meeting. So I had them fill this out as well. This is a lot of essentially the same exact invoice, or not the same, but similar of maintaining for the past year. If you add these up, it adds up above 25,000. So you are more than welcome to go through and look. But essentially that's what it is. It's invoices from,
I'll take the first 50. I'm good with this.
I don't feel the need to scan through every invoice, I
Okay.
think this is more than
So a
reasonable,
yes?
it's our usual.
and like I said, this is the annual contribution. We upped it last year from 17.5 to 25 to kind of be more in line, because the 17.5 hadn't been increased in, I don't remember the exact amount of years, but a decent amount of years. And with how much everything else has increased, the contracts on mowing, maintaining, not winterizing, that's not the right word, but I'm not a landscaper, the pre-season stuff and the fall cleanup type situation, it is more in line.
So we're motioning to make an annual $25,000 contribution from the cemetery trust funds to offset the town's expenses for FY '24. Did I articulate that correctly?
Second.
Agreed?
Yeah, we are in favor. Very good. We'll just figure out how to record that. Capturing minutes by hand today.
And the cost of the plot is going up.
I suppose
Yes.
We got the last $600 one.
At the last meeting, they had voted to increase it. The town, Londonderry was for a while cheaper than a lot of the surrounding areas, so they did some
Yeah.
research into the
Yeah.
surrounding areas and brought it more
We're
in
gonna
line.
go there this weekend and have a picnic.
There you go. Thank you. This last one is a withdrawal again from the same fund, the income from the cemetery trust. The Finnegan Fence Company was able to donate the actual fence to repair at Pillsbury. The one thing that they were looking for was the labor and the cement that it cost to put it in, but the fence itself they donated. The cemetery trustees authorized up to $2,000 for the expense, and it came in at 17.
Did they get, say, some recognition for the donation, or? again, let's not,
I don't know if we have yet,
okay,
but they should.
perfect.
They should, because the fence is this is the cheap part. Not trying to downplay it, but the fence is much more expensive.
Yeah,
Them being able to donate that was very valuable to saving money for the town.
okay.
Um,
Just curious,
It's a local business, which is great for that as well.
yeah, I'm just curious if they might say something like one of the next meetings with council is there.
I think we may be waiting for this aspect, so that way we can say
Oh.
where the additional money came from.
Perfect.
Should that question be asked, that way it's not a we're pending type situation.
Gotcha.
And then, it's this guy, 'cause
I'm in agreement with the cemetery trustees, I think everything's in order.
Yes, the,
The request for that fence
let's see.
payment, that meets the intent of the fund, the fence repair.
Very good.
Yep.
So motion to approve the withdrawal of 1,700 to concur with cemetery trustees and offset the expense of the Pillsbury fence repair.
Second?
Everyone's in favor? Very good, very good.
So in terms of the who has delegation authority, if you guys want me to, I have no problem reaching out, figuring out the actual details. I just personally, I thought of it as a nice idea to have both of you, that way everyone stays aware, if that makes sense. And then hopefully there won't ever be disagreements, but if there are, we can address it at that point of who has actual supreme authority. It's one of those that I plan on looking into, but in terms of
More information
priority
is better.
list, it drops because the worst case scenario right now, more people are aware.
Right, due diligence, far and beyond due diligence, covering all bases, that's.
Right. And it's one that both should be aware of money coming in and out, because both are impacted by it. All right, so the next thing is capital reserves. As you guys are aware, we established the new one. If you look, I was actually able to print this out. And I apologize, I forgot about the June bank statement, for TD. For TD is the capital, where the capital reserves are held, but this is as of today at 2/38, the balance in
Okay.
those accounts.
Are you saying without producing the actual statement, this is the account snapshot that you grabbed earlier?
Yep, I logged in and I found out that I could print this, which I thought was really neat and useful, I'll be honest, because it gives it to you as of that point. We have made the transfers based on the election results. And that's this fund binder here that we have, as well as some of the previous expenses. Just so you guys are aware, we received a payment from the school. This is last year's, if you have any questions regarding that. Yep, so this is last fiscal year's. So if you want to see June's or, sorry, maybe.
This is just your paper documentation of the transfers that you
Yeah.
made on our behalf after
Yeah.
after the March election.
Yep. So because I don't think any of them were 100% UFA. Either way, it was done in July, not March, the new fiscal year.
But as a result of
Yeah.
the March elections, but done into the new fiscal year.
Yeah.
Got it. Comfortable with that?
And I mean, you could, if you were to look at May versus here, you could likely see not likely, you would be able to see the increase.
document to the SW group in general.
I have to give credit to my controller on that one, she's very good at that. The other thing I want to touch base with you guys on regarding these is this was easier when we didn't have to break it out between the two. Sorry, give me 1 second. So between the town and the school capital reserves, last fiscal year, they earned approximately 46,000-ish, 47,000-ish in interest, with a significant majority of that coming from December forward when you guys authorized us to move banks to the better interest rate at T-Day. As I think I laid out back when we switched over, the first 5 months, 5 months, July through November, you were getting about 110 to 130 per month. In December alone, where we switched over when we switched over, not on December 1st, I don't believe. I think it was like the 4th or 5th. I don't remember exactly, but within there, that earned about $5,000 between the two. So, in comparison to the first 5 months, it's significant, and hopefully it'll keep growing and growing. So I just wanted to touch base with you guys on that and give you an update for that. The last item that I believe I have is the acceptance of last meeting's minutes.
Should I make a motion to approve the minutes?
Ken, what's your side chance?
Second.
Okay, everyone in favor? All right,
Aye.
motion to approve the May minutes.
Perfect. And then setting our next meeting.
Recommendations on timeframe business will need to be conducted. We discussed, it looks like from the minutes that we just approved, we discussed potentially meeting in August, but I don't know if that was in preparation for this meeting. If there was any other business that you need us to conduct.
The only other item that I'll need is your guys' approval to submit the MS 9 and 10, which I think last year we did it via email where I sent it to you all to review, and then you said, yep, go ahead and submit it. So it's up to you guys if you want to do that in person, or if you are okay proceeding in that manner.
When is that due by?
I believe that one is September 1st.
Okay. But I don't think there's anything that prevents us from making a motion of that now. opposed to waiting for a July or an August meeting. So I would make a motion to empower Justin to submit our MS9 and MS10 and MS10 forms by the state's deadline.
Second that.
All right.
Great.
Everybody's in favor?
Yep.
All right, we'll
Now-
just record that motion today.
And do you send us something we would sign, return to you, or just
So-
email confirmation okay?
I'll email confirmation, okay.
Oh, perfect.
So what I'll do is, even though you guys authorized me, what I'll do is I'm still gonna send it to you in case you guys have anything where it's like, wait a minute, I thought it was supposed to be this number and
Okay.
all that. And then once I get 2 of the 3 saying good to go, I'll hit submit.
Excellent.
Yeah. Yes.
Motion to double the trustee's salary for next year?
Absolutely. 2 times 0 is.
So what are we, you're gonna send that out via email just in case there's any
Yep.
questions or whatnot? I don't anticipate any second looks or questions. When would be helpful to plan to meet again?
Um,
Does the school board have requests that come out after the start of the year, or are we anticipating particular council orders at any time?
not at this time. I'm trying to think of any other deadlines that may be coming up. That's the big one, is that in terms of requests, we'll have some here or there, but they don't need to be issued instantly. The school historically has held on to the request until April, May, or June, and then submitted them all at once. So it's up to you guys if you want to meet August, September, October.
I'd just like it after the 21st of September,
Okay.
because I've got my senior information expo, and that's gonna take some time between now and then.
I would be agreeable to meeting in October. It's 3 months out, but if we're not gonna have significant business to conduct until,
Yep.
does that work?
And I mean, worst case, if something comes up, I'll send you guys an email and we can set up a meeting at that point.
Mhm.
So we looked roughly 3 months out. It's Thursday, October 24th.
So
Objections to that date? Your availability?
my request would be earlier, just because November 2nd is when we present next year's fiscal year budget. So, straight out.
You'll be in budget season, so you'd like us to do it a little sooner, back that up a week or two?
If you're able to do it, the week before that week, so the week of the 13th or before, that would be ideal.
We said the 10th instead, Thursday, October 10th. Any objections on our end? Gives them more standoff from budget season?
Yes.
Just those last 2 weeks before I present, it's triple, quadruple checking, verifying, and every little change I can make and savings I can find and all that fun stuff. So,
The 10th and 11th.
whatever works for you
10, 10,
guys.
11. Everybody, that work for everybody?
10, 10, yep.
10, 10, and 11 should be too easy to remember then. We're in 10, 10.
Almost seems like we should start at 10, doesn't it?
Yeah. 10, 10.
Are you guys all receiving your Town of Wonder emails?
I got
Yes.
locked out again. I have to get mine fixed again. If I send you a copy of the minutes of disbursement, actually, can you confirm what the new email is?
My new email?
Yes.
It's the same, just .gov. So it's jcampo@londonderrynh.gov. And I believe the .orgs are still being sent to us.
Very good. I'll make sure it's sent to you. Confirm second? All right, you're in favor, we adjourn to 12:47.
Wonderful. As
For all the
always.
time, as always. Didn't
Absolutely.
mean to speak over you.
No, you're good. I was just about to get my, as always, if you guys have any questions, you know how to get a hold of me.
Very good, we'll look forward to circling up again in October unless you email us with some crucial between now and then.
Wonderful.
Excellent, thank you.
Absolutely.